Starting a new job or getting a raise right before buying a home sounds exciting until you realize it might throw off your entire loan approval. Most buyers think that lenders need months of pay stubs before they'll count that income, but that's not always true. You can sometimes qualify with your new salary before you even start the job. And under Freddie Mac rules, a guaranteed raise might actually help you qualify for more. So in this video, I'll show you exactly how it works, when the new income counts, what lenders look for, and how to use that job offer or promotion to buy your home sooner. Job changes are normal, especially when you're moving or advancing your career, but mortgage underwriters care about income stability. So if your offer letter says you'll start next month, most people assume that they can't close until after that first pay stub hits. That used to be true across the board until Freddie Mac and Fannie Mae updated their guidelines. Conventional loans can let you qualify with income from a new job that hasn't even started yet, as long as certain conditions are met. Think of it like a grace window. Lenders can use that future salary if your start date is within 90 days after closing and your offer letter is final. Freddie Mac goes one step further. They'll even count a future raise from your current employer if it's guaranteed in writing. Fannie Mae doesn't, so which loan program your lender uses actually matters. This option works best for buyers with a steady base salary. If your income changes from week to week or depending on commissions or bonuses, this guideline doesn't apply. Your employer also can't be a family member or anyone involved in the transaction, like a builder, an agent, or a seller, to keep everything above board. The clock starts at closing, so your start date has to be within 90 days of your closing date. If you start on day 91, that income can't count, so timing matters. You can use this rule when you're buying a home and in some cases when refinancing, depending on the loan program. Here's the paperwork most lenders ask for before they'll count that future income. You want a signed offer letter or employment contract showing your position, start date, and base salary. Verification from your employer, usually from HR, confirming you've accepted and everything's final. Proof of savings or reserves, often 1 to 3 months of payments, so principal, interest, taxes, and insurance, to cover expenses until your first paycheck. For a future raise with your current employer, which is again Freddie Mac only, a written statement on company letterhead showing the raise amount and the effective date. Now let's say you're moving from Oregon to Texas for a new engineering job that starts in 6 weeks. Your offer letter shows a $95,000 salary and a July 1st start date, and you're closing on May 15th. Because that start date is within 90 days, your lender can use that $95,000 to qualify you right now. They'll just need that offer letter and proof that you can cover payments until your first paycheck. So if you close May 15th, you move in June, and you start work on July 1, simple and approved. Now imagine you're staying with the same company, but just got promoted from assistant manager to manager with a $10,000 raise starting next month. Freddie Mac lets lenders count that new salary if it's documented and guaranteed, meaning you could qualify for a slightly higher price today, even before that raise appears on your pay stub. Fannie Mae, however, requires the raise to already be in effect. Whether it's a new job or a future raise, one rule stays the same. You have to show you can afford the payments until your new income starts. That's where reserves come in. It's a financial bridge between now and your first new paycheck. Freddie Mac and Fannie Mae both require a cushion of savings. For a single unit home, that might mean 2 months of payments. Multi-unit or second homes could require more. This rule applies to 1 to 4 unit primary residences and second homes. Freddie Mac also allows certain investment properties if you meet the higher reserve and qualification standards. Here's how lenders double check everything. If you haven't started yet, they'll call your HR department to confirm your start date before funding. They might ask for your signed acceptance letter or proof you've left your prior job. Sometimes they'll request proof of relocation, like a lease termination or a moving receipt, to verify you're actually taking the position. The goal is to ensure nothing changes between approval and closing. The biggest mistake buyers make is letting employment details shift mid-process. If your start date moves beyond 90 days or your pay structure changes, your approval can be delayed or denied. Another common issue is skipping proof of reserves. That's not optional. And if you change jobs after you're under contract without notifying your lender, it can reset your approval entirely, and we will always find out. So always keep your lender updated. This rule is a game changer for anyone relocating for work, recent graduates starting a new position, or professionals earning a promotion. It lets you lock in your new home now instead of waiting months for your first pay stub, and that can make all the difference in a competitive market. So if you're starting a new job soon and you don't want to put your home search on pause, this could be the perfect fit. Reach out and we'll review your offer letter, calculate what you qualify for, and make sure your timeline fits conventional loan rules. Click the link below to schedule your call with my team. And if you found this helpful, subscribe for more straightforward mortgage tips that help you buy smarter and close with confidence.